I'm Mike Tove with AIN Services.
And I'm Bill Alexander with W.G. Alexander and Associates. We're attorneys for estate planning, elder law, and asset protection.
Welcome to Money Secrets with Bill and Mike. So you know what, Bill, the last couple of weeks we have been talking about these new tax law changes.
Yes, sir.
And what they're going to do or not do to folks.
Well, obviously, in terms of the taxes themselves, that'll have implications to everybody. But I think today is one of the most important days for us to talk to folks about what will actually happen that they need to care about.
Yes.
As it relates to the real effects.
Because I think there are some very real effects coming.
No question about it.
So we're going to be right back and we're going to get into what this is. Please stay tuned.
This will be a real money secret day.
Oh my gosh, yes. Welcome back. Bill, where we are right now with regard to markets reminds me a lot of 1999.
No question about it.
I had a woman attend a workshop of mine, this is like a long time ago, but literally in the spring of '99, and she came up to me and she said, quote, "You can throw darts at the stock market and make money in it." And I suggested that that was a very dangerous idea. And of course, less than a year later, it crashed.
But you know, back in 1999, we'd had 10 years of sustained growth. I mean, it was the best economic time in this country. We had, we basically had been able to push back our deficit and our debt, and we were in great financial shape in the country.
Except we had one of the foremost economists in the world, Robert Shiller, warning something called irrational exuberance. And what's interesting is he used that phrase in a Fed policy briefing to Alan Greenspan. A few days later, I think it was 3 days later, Greenspan actually in a Fed policy speech said, quote, "Well, how do we know if we have irrational exuberance? Don't worry about it." And the next day the markets plunged literally around the world up to 4% on 2 words.
Well, Shiller was a lot smarter than Greenspan.
Yes, no comment. But I am afraid that we are in familiar ground.
Well, we're certainly entering that territory again. And in fact, that's what is so important about this show today.
But let's take it why. Let's talk about why. So first off, we have discussed that we have this new set of tax laws that's going to cause the deficit to go up and perhaps by $1 trillion over the next 10 years.
Actually, even conservatively, they're looking at an additional $1.5 trillion added to our deficit over the next 10 years.
Right.
And that's sort of minimal. It could be worse than that.
And then we have, when this new tax law was put into place, that it was signed into law in December, which mandates that spending cuts must occur this year.
Right. In fact, congressional leaders had actually recommended strongly that the signing for the tax bill occur in January. And for whatever reason,
they didn't listen to it.
The president actually got his folks together. It wasn't scheduled, but he said, "No, we have to do it so I can basically say that this was done in my first year in office." And unfortunately, that had some serious repercussions in terms of what Congress has to do this year.
Right. So, and who's going to be hit by this?
Yeah, Congress wanted to kick the can down the road a year.
The reason for that would be important is by kicking it down the road, you defer by a year when the what is going to hit the fan.
Right, exactly.
And then you've got two other things.
But the rationale is this is an election year, and they didn't want to have to make those hard choices this year.
But then you've got two other things. First of all, right now markets are overpriced more than they have ever been in U.S. history, including 1929, with the sole exception of leading up to the dot-com bubble blow up in 2000.
Well, and then no one can forget what happened in 2008 as it relates to the entire market crashing
and
for
yet
everyone.
the
I had
markets
clients
are now,
who lost 50% and more.
And yet the market overvaluation right now is far greater than it was in the fall of 07. In fact, we're 2 to 1, which means that if the markets simply go down mathematically to their 137-year historical average, that's a 50% drop.
Well, and the sad news is Wall Street's at it again. I mean, just this weekend I saw a report where they were talking about, oh, the markets are so wonderful, new money's pouring in, folks feel wonderful about this market, and now's the time to get in.
Irrational exuberance.
Well, to me, it's Wall Street taking advantage of Main Street, because most of us are not sophisticated investors. And of course, the easy rule of thumb is buy low, sell high.
Right.
Well, guess what? Right
It's
when you
high.
say it's overpriced, that means that whatever investment you have in the market right now is a very high-priced investment.
And so why hasn't the selling already started? Actually, there's a very simple answer. Now, it's probably a lot more complicated than this, but one of the simple answers is that when people are selling, they have to put their money somewhere, and traditionally it goes into bonds. Bond rates have been historically low.
And they still are.
But guess what they're doing? They're coming up.
Well, and of course, so much is interest rate sensitive, so when bond markets go up, inflation goes up, mortgages go up,
and
cost of living goes up.
And where we're headed is a recession.
No question about it.
And it's going to catch people off guard.
Well,
and that's the challenge.
We know. And what does a correction mean, Mike?
Well, officially it's 10% or more, but guess what? In 2015, we actually had 2 of them in 1 year. That's not what I'm talking about. We're talking about something at the order of 2007, 2000. Stay tuned. We're going to have to come back, take a short break. We'll be right back, and we're going to get into this and try to talk about what the money secret for solving this is.
So what do you think of when I say there might be a stock market correction?
I think there very well could be. It's been going up so fast and quickly that at any time it does that in the past, I've seen it go down. So it could very well correct itself.
I don't know that we were really affected that much, but I don't think it's going to have a lot of effect on the market. I think the market will continue to do what it's been doing in the recent months.
I would be very disappointed because my 401k has been doing very well in this past year, and I would like to make sure that it continued to grow. I'm sure it's not going to do that forever, but I hope when it is corrected, it's not too drastic.
It's very frightening. My husband and I, the majority of our profit sharing is what we live off of, and watching the stocks go up and down right now is a scary proposition for us.
Welcome back.
Well, Mike, it's always fun to see what people have to
I
say.
know.
Because there's so much information out there, whether people get their news wherever they get their news.
Or misinformation.
Right, and that's the problem. Is that we're being pushed by folks in the wrong direction, I think.
Well, that's the thing, and we've been over this before. Is that why do people push in one particular direction?
Well,
because of a bias.
They want to make money. And
Right.
guess what? The sophisticated investors right now are starting to move their money slowly. They don't want the folks on Main Street to realize that they're positioning themselves for this correction that's taking place.
Well, I don't know how secret it is. I mean, I was just recently on a webinar by Roger Ibbotson, who, as it turns out, is the second most decorated economist ever. And he was making some very strong recommendations of getting away from market risk. But I have seen articles from Warren Buffett on this, from John Vogel, I believe not long ago, even one of the big, I'm
Well,
blanking, but
I know,
we're coming out on,
and we both know that no matter how smart you are, you cannot predict when a correction will take place.
No.
That is the day or the week that a correction
well,
is
even
going to take
Schiller,
place.
Schiller back in the 90s developed this index that looks at the value, not the price, but the value of markets as a way of seeing what's going on. And even he is adamant that you cannot use it to predict when a correction is going to occur.
However,
Long-term trends,
absolutely.
yes.
With that said, we know that corrections take place. You cannot have a market that only goes in one direction. And at least from my reading and synopsis, and of course I think you can agree, that most really wise investors and people who follow the economy believe that this correction will happen sooner than later. In other words, 2 to 6 months. And of course, it could happen next week. I mean, for us, it's simply a matter of throwing out the alarm bells for Main Street.
Right.
Wall Street knows this, but Main Street's getting the bad information that says stay in and keep investing and don't change things.
The other piece to this is that there is a misremembrance, if you will, as to how significant these things can be. And I get a lot of clients that will come to me and they'll say, well, that's all right, I'll be fine. But the reality is that if you've got more years behind you than in front of you for retirement, you may not be.
No question about it. It's really important for folks to understand the math. And that is, if you lose 15% of your portfolio in a market correction, you have to earn 30% over the next few years to get back to zero.
Right. Well,
and that takes a long time. You can't just get back to zero
here's a statistic,
that fast.
and I've got the data on this, is that if somebody had $1 invested on January 1st, 2000, compared to, based on inflation adjusted, for them to have they went through the correction, then it came up, then it went down, and for them to have broken even on their dollar, that would have been mid-year 2016.
Wow. So I guess they've made about 20 cents on their dollar since then.
16 and a half years to break even.
Well, that's the whole point, is that if you can avoid losses, you are in much stronger position than those. Now, young people can absorb a loss because folks do realize that over time the stock market does far better than the bond market as it relates to
the
investments.
banks or any other traditional
well,
things.
yeah, banks are very low end.
Well, but banks serve a
hardly
purpose,
makes
to be fair.
inflation.
Yeah, but to be fair, they all serve a valid purpose. But what I would like to do is I want to go back out to our folks on the street. So let's see what the good folks out there think. Stay tuned.
Are you worried about the stock market at all now that seems to be changing a little bit as well?
Yes, I'm worried about the stock market.
I'm not so much concerned with the dip, but I am concerned if it will stay, how long it stays like this.
No, the stock market, always goes up and down, but it always seems to have a way to, steadily increase over time. And healthy businesses are going to continue to do well.
Not at all.
Yeah, definitely so. We've been on such a ride for the last 14 months, but I kind of saw they're just going to come to an end at some point. But I don't think it'll crash. It might correct itself, but I don't see it crashing.
They upped the mortgage rates on Friday, which causes the stock market to crash. And just as people are getting back on their feet, it's going to cause problems again for the middle class.
I literally had all my life savings in Bitcoin.
It seems, just like speculating, it seems like we saw the housing bubble burst. And with that information, I think it's easier to look around and identify other places where we're accepting as normative what is probably exceptional. And so I wouldn't.
Wow, that was interesting.
Of course it is.
But not surprising. I guess there's several different, there are always people out there that will say, I'll just ride it out.
Of course.
But think
And-
about this.
Well, let's wait a minute. Let's
Yeah.
talk about that, because truthfully, at least in my experience, when we're in times like this, most financial advisors, in my mind, give us poor advice. They basically tell us to stay the course. In other words, you got to be in the market in order to get those rises.
It's like a recording. I mean, if when the markets are going up and you call the advisor and they say stay the course, right? And then when the markets are plunging, you call them up and say, oh, what should I do? And stay the course, stay the course.
Well,
and there's validity in it sometimes.
Yes,
But
there
that's not
there
an
is
answer.
at times, because again, nobody can call when that correction will exactly come. But we know it's coming sooner than later, and this is the time for folks to make changes. So the money secret
So
has to be what
do something
changes.
different, right.
Yeah, I mean, the bottom line is and there are things that folks can do in terms of making their money safer.
Well, let's talk about what you could theoretically do. You could move your money into the banks.
Sure.
And that's fine if you want to live off of a fraction of 1%.
Right, and of course that's not even going to beat inflation, but it is safe. It's better than losing your money.
You could move your money into bonds.
True.
And there's a problem with that.
Well,
the problem is that first of all, your returns are still not going to be very strong, because that's your coupons, your interest rates that you get paid are low. But as the bond interest is going up, which it is.
Well, we know that interest rates are going up. They're not going back down.
You access that money, you're going to lose.
Well, and a lot of folks don't realize this, but when interest rates go up, any bond that you currently own, the value of that bond goes down. Because the value of the bond and interest rates have to be at a par.
So there's only one other avenue, and we've talked about this before.
Well, before you get to that, there are a lot of things that people can do, but a lot of times their financial advisors don't like them to do it.
Right.
For instance, just getting into pure cash is better than having a huge loss. If you're into where you own individual stocks, equities, or if you're into exchange traded funds, you can put stop losses on those investments. Right. Most financial advisors don't like to do that, and they'll warn you against it, but this is the time to have stop losses. You can, and I'm not recommending that folks short the market, although that's
a sophisticated thing.
That's for Wall Street investors, I think. But stop losses can be used by Main Street investors very successfully.
However, there is a problem with stop losses, and that is that with as volatile as markets are, you have to put the stop loss low enough that it's not going to trigger just on a short-term daily thing. Okay.
The bottom line is the indexes are better today than they
better.
ever have been before, and they're not capped
And that's the other thing, is that they are not capped. Key is that most brokers don't have access to them. Most financial experts don't have access to them. They are limited in terms of who gets them.
Well, and I would say that's particularly true for folks with retirement accounts.
Yes.
It's one of the best places that you can go with retirement accounts.
All right. So we're going to have to take a short break, and then we're going to come in for a final wrap-up. Please stay tuned. Hey, welcome back. We're advocating a specific solution, but it's not for everybody or every dollar. Nothing is.
No question about it. But the bottom line is this is a time to make a change.
Yes.
This is not the time to stay the course. That may be the most important money secret, but then how you make the change is really important.
Right.
And there are a number of things that you should do now, or at least sooner rather than later.
Sooner than later.
This is not the time to procrastinate when it comes to your nest egg.
No, but you know what? So the next time you're out and about and you see one of our little camera crews out there, walk up, say hey. Maybe you'll be on TV too.
We would love it.
Yeah. And so stay tuned next week for the next Money Secret with Bill and Mike.
See you then.
See you then.
You've been watching Bill and Mike with Money Secrets. Bill Alexander is an attorney with W.G. Alexander & Associates in Raleigh. They focus on estate planning, asset protection, and elder law. Find them at wgalaw.com. You can catch Bill on the radio on Saturday mornings at 11 a.m. with Asset Protection Today on WPTF 680 AM. And come join him on every second Wednesday of the month for a free seminar. Just call 919-256-7000 for more information. That's 919-256-7000. Mike Tove is a financial planner with AIN Services. They can be reached for all your planning needs at 1-800-363-2296 or online at ain-services.com. You can also join Mike Tove for seminars on how to take control of your retirement. Just call 1-800-363-2296 to find out when he will be in a city near you.